Stocks edging higher following yesterday's rally. This as consumer confidence falls to the lowest level in 4 years. Joining me now, we've got James Ragan, who is D.A. Davidson Director of Wealth Management Research. Great to have you here with us. You're watching consumer discretionary in that sector. You say it's an attractive play for patient investors right now. How patient do I need to be?
Well, not too patient. We've seen the sector really underperform this year. It's been, down on an equal weight basis and, really due to concerns about consumer spending and where the economy is coming in. And I think that started in January when we had a very weak consumer data, but we do expect it to improve from here. And so there's just been kind of an avoidance of the sector, a lot of selling. So we're seeing much cheaper valuations. There could be some more volatility ahead, but we think investors that are looking out over the course of the year can find some pretty good values now in stocks across the consumer space, whether it's in retail or apparel, some of the leisure stocks and so forth.
And so as we're thinking about all this, James, and one of the major things that investors have been navigating with the most recent volatility is just what's the real play out of these reciprocal tariffs could look like. How are you factoring that into your own investment strategy and thesis right now?
Well, the threat of tariffs has really weighed on consumer confidence. So we've seen the confidence come in weak, and where that really rolled over was when we saw the impact of the tariffs on the import data from January, and so the GDP trackers kind of turned negative. And so, it's a risk to the market that the tariffs will weigh heavily and cause some disruptions to the supply chain. We're still in the camp that there's trade negotiations ahead. We think there's going to be a mix of some tariffs sticking and then some tariffs being relegated to some kind of a trade deal. So we know that the president wants to see investment in the U.S., wants to see markets opened up to U.S. companies a little bit more. So we think that this is a key week leading into the tariff announcement next week, that if we are going to see some trade deals, we'd like to see some of them happen before those tariffs get announced.
Yeah, certainly. And so as you were running through some of the areas of consumer discretionary and what makes that trade, it also comes back to what we're seeing right now with consumer confidence too, and where there is some impact, some cracks in how consumers are thinking about the overall vibe right now, and especially as it comes back to the employment data as well and those prospects. So as you're continuing to get future economic data readings, what is the core economic data reading that you're looking to give even further of evidence of how the consumer is thinking right now?
Well, certainly the labor data is going to be key. We'll have jobs reports coming out next week. There's some concern that maybe some of the government layoffs will start to hit the headline jobs data. So we'll be looking below the line a little bit to see kind of how jobs growth is going out through the private economy. So I think that's key in the analysis. And then also, we'll look to the retail sales. I think there's still a couple weeks out before we'll get the March retail sales reading. We've known that the low income consumer has been under some pressure over the last couple of quarters. And it's been more of the high-income consumers that are generating the spending. I think that's where the consumer confidence weakness comes into play. When the market was at its lows, we were a little more concerned about a wealth effect, reverse wealth effect, maybe limiting some of the higher-end spending if consumers delay those purchases. But now with the market coming off the lows a bit, that maybe that's less of a concern. But I think it's really going to be the jobs data that we'll focus on the most over the next couple of weeks.
Yeah, certainly. Just lastly, while we have you here, as investors look for clues as to when they can really sense that risk is back on, risk is back in vogue, if you will, what are some of the clues that they should look to within the market and some of the larger inputs that they should be tracking?
I mean, it's going to be tough. I think the market is very sensitive to surprises still on the positive and on the negative side. I think the market sell-off has been a growth scare, so a fear that maybe we go into a recession, which we don't think is likely at all at this point, and a fear that the earnings erosion, starts to happen a bit. So I think at this point, though, our view is that we're going to see, a little lower than trend GDP growth this year, but still stay very positive, and maybe some vulnerability to the earnings numbers. So, the next earnings read that we'll get really will start here in a few weeks when the first quarter earnings start to be reported. And so that's a clue that if we see stronger than expected earnings and then decent guidance for the year, I think that's maybe a little more of a challenge. That could get us more to a risk back on environment. But absent that, I think we can probably expect some more volatility along the way.
James, thanks so much for joining us and taking the time.
All right. Thank you, Brad.